Today we're going to discuss the 10 steps you need to take to buy your first home in Southern California. So whether you're a first-time home buyer or maybe a seasoned buyer that's looking to upsize or downsize, you wouldn't want to miss what I have to say. My name is Roman. I'm a real estate agent here in Southern California with close to 20 years of experience in residential markets. I know what it takes to buy and sell a home here in Southern California. So if you're looking to buy, sell, or invest in real estate here in Southern California, drop me a comment down below or contact me for a more of a personalized one-on-one approach. So the first step you need to take when buying a house is assess your financing. And let's break that down into 3 categories. So your savings, your income, and your credit. Now, your savings, it's not necessarily the whole savings you have, but more of a down payment and what you need for closing costs. So common misconception is you need 20% down to buy a house. That's not the case. There's a lot of loan programs that you may qualify for. The simplest one or the easiest one will be FHA financing that's perfect for first-time homebuyers. Typically, they have a 3.5% down payment, so let's use that for reference. I would probably say another 3 to 3.5% is for closing costs. So total, you would need about 7% out of pocket or in your savings account if you're looking to buy a house. Now, if we're looking at a $500,000 house, you're looking at roughly about $35,000 out of pocket. Something else to consider is a lot of times, or most of the time, we can include closing costs into the loan when submitting an offer. So the seller that's selling the house essentially can help you with some or most of your closing costs. There's also a lot of programs such as grants for first-time homebuyers that will help you with closing costs, and most of the time those are forgivable. However, I wouldn't count too much on those because you do need to qualify, and a lot of buyers simply don't qualify based on their income, based on the house, the location they're buying the house in. So it's a good idea just to have that money in your savings account. Now, of course, the more money you put down, the better it is for your loan. So the higher the down payment, the lower the monthly payment is going forward. Let's talk about income. You need 2 years of income. So you have to be employed for 2 years with no major gaps. Now, you don't have to work for the same company for 2 years. However, it has to be in the same field and no major gaps. Otherwise, you're going to have issues with getting your pre-approval. And this is for your W-2 borrowers that are working for a company. If you're self-employed, it's a little different guidelines, but similar where you still need to be employed or have your business tax returns for at least 2 years. Finally, let's talk about the credit score. To qualify, you need a credit score of as little as 620 to qualify for a mortgage, and that's typically your FHA financing. If you're looking to get a great deal, a great rate, you want to be in the 680s and up. If you're looking for the best rate, the best fees or no fees, where you can shop around and get the best of the best, you're looking at a 720 FICO score and above. So step number 2 is hire a real estate agent. Interview a few real estate agents and see which one fits your needs best or which one you connect with. You do have a couple options here. Now, option 1 is you could do the search on your own, attend open houses, and possibly go straight to the listing agent. Option 2 is you can hire a buyer's agent like myself or any other buyer's agent, and the benefits of using a buyer's agent versus of going straight to the listing agent is you have somebody on your side. The listing agent, their duty is to the seller. So their priority is the seller to get the highest dollar amount, the best terms for the seller. Now, they'll still help you out as well, but a common misconception is if you go to the listing agent, you're going to get a better deal because he's getting double the commission. Well, he's doing double the work. So essentially, yeah, he's going to get double the commission, but he's still going to pocket the commission. The seller's not going to see a difference in his net amount because he still has to pay that commission. So as a buyer, you're better off getting a buyer's agent that's on your side. One that doesn't cost you anything yet. It's still being paid out of the seller's proceeds. So the seller pays the buyer's agent commission. So you as the buyer, you're not obligated for the most part. Now, there are exceptions if you're looking to buy a for sale by owner, let's say listing. Those typically don't pay any commission, and that's something that would have to be negotiated either with the seller or the buyer. Another benefit of using a buyer's agent is that we're on your side. It's in our best interest to get you the best deal on the house, whether it's the price, the terms, or a combination of both. And of course, follow through with the closing. Make sure that inspections check out, and if we need to renegotiate again, that's where we come in. So at the end of the day, we're professionals in our field. We help you manage the real estate transaction that's very complex, and at any time there's 15 to 20 people involved in one transaction, from your home inspectors, from your underwriters to your notary publics to transaction coordinators from both sides to different team members on both sides from the buying and the selling side. We help manage that and make sure we come to a smooth close. We help negotiate. As I mentioned before, we help negotiate not just the price but the terms, whether you're looking for a longer escrow or shorter escrow. Longer contingencies, shorter contingencies will help you advise on the best possible way to submit an offer and get it accepted. Also, when hiring a real estate agent or interviewing for a real estate agent, make sure the real estate agent is full-time. There's nothing worse than calling your realtor and he's at work or he's at his first job and he's not answering the phone. So essentially, get a real estate agent that's full-time. So your third step is get a pre-approval. Now, you have a few options here. You typically can go to your local bank, such as Bank of America, US Bank, or Citibank. Your second option would be is get a mortgage broker. Again, they can be local or out of state as long as they are licensed to do business in Southern California or in California. And your third option is go with an online lender such as Quicken, Rocket Mortgage, Loan Depot, and to name a few. Now, the pros and cons of each would be if you're looking to go to your local bank, let's say either a bank or a credit union, they don't offer as many programs as, let's say, a mortgage broker would. Now, it's convenient. You could go in, sit down, get everything done, or get all your paperwork in person and move on with your day. That's a plus. The negative is a lot of these banks, or a lot of them, will work from 9 a.m. till maybe 6 p.m. So if there's anything that you need after hours, it's almost impossible to get a hold of anyone most of the time. Now, there are exceptions, but from my experience of 20 years in the real estate industry is that nobody picks up the phone after 6:30, 7 o'clock. So if you do need something after you're done working or something late minute comes up, you have to wait till the morning. Now, another con is a lot of times when you speak to one loan officer and you talk to him or her, that file gets sent out and you're dealing with 5-6 different people from underwriters, and it's just a huge email chain, which sometimes becomes confusing. Or if you need something, even during business hours, it's harder to get. So just something to think about when dealing with a local bank or credit union. Of course, there are exceptions where I've dealt with great banks and everything was smooth and we closed on time. However, most of the time, those are the issues that I personally ran into. So the next option is a mortgage broker. Out of all the three options, I personally like mortgage brokers. Now, they're competitive. They have many different loan programs. So if you're the type of buyer that doesn't qualify for your standard conventional financing or FHA financing, a good mortgage broker will sit down and they will try to find a loan program that fits your needs. Now, it could be slightly higher rate, maybe it's going to cost you a little more than your traditional financing, but at least you qualify and you can get the house that you dreamed of. That's a huge plus of working with a mortgage broker. Another plus is they're highly competitive. So if you do find a better rate somewhere else, you could always go back and renegotiate either closing cost, fees, or whatever you like. That's also a possibility. Number 3 is online lenders. So your online lenders such as Quicken, Rocket Mortgage, also great, convenient. So if you like to do everything on the go from your phone, that will be your best option. Now, similar to the bank, you also get limited hours or after hours, and you're also dealing with multiple people. So you're gonna talk to Bob Smith, and then Bob Smith's gonna send out your file to 5-6 other underwriters. So you're gonna see an email chain, and sometimes it does become confusing. Now, some online lenders, they are notorious for not getting stuff done on time. If you have a certain contingency, such as your loan or appraisal, it may be delayed. I've had that happen quite a bit of times with certain online lenders. So let's discuss the type of loans that are available for you. Now, there's numerous types of programs. The best ones, or the top common ones, are FHA financing, which is 3.5% down, your conventional financing, which is your 5% to 20% and up down payment. Then you have your VA loans, which are for veterans, and those typically are 100% financing. And you also have your ARM loans, adjustable rate mortgage, which are typically fixed for a certain amount of years and then they adjust afterwards. So they can be fixed for 3 years, 5 years, 7 years, or 10 years, and then they adjust with the market. So great loan program if you looking to sell your house or get out of that house, or maybe refinance in the future, because you do get lower rates compared to your conventional 30-year or 15-year fixed mortgage. So a common concern I hear from my clients when the time comes to getting a pre-approval is that they don't want their credit ran, or because the credit score is going to go down. So unfortunately, there's no other way for a lender to issue a pre-approval unless they see your full history. They want to make sure, they need to see your debt, they need to see your credit score, because your financing will vary based on those numbers. The good news is, if you run it once, yes, you're going to lose a few points off your credit score. However, you can still shop around with multiple different lenders as long as you fall within the 45-day window. So you can go to your mortgage broker, you can go to your local bank or credit union and see who offers you the best rate. So another thing to consider when it comes to mortgage pre-approvals and types of loans is if you're looking for FHA financing or VA and you're looking to buy, let's say, a condominium or a townhouse, a lot of complexes are not VA or FHA approved. Some lenders can do a spot approval, but it's a 50-50 chance that it'll get accepted. Ideally, if you're looking to buy a condo or a townhouse and you're looking for FHA financing, I would highly recommend going with conventional financing, 5% down. If there is no choice and you must go FHA because of the DTI or whatnot, then essentially you're limited to how many condo complexes are approved, and you're also limited when we're submitting an offer that the selling side will consider it because it's still not guaranteed that it'll get approved on the spot. So something to consider. So similar to FHA is the VA. There's a lot of complexes, condo and townhomes, that are not approved for VA financing. So if you're using a VA financing and you're looking to buy a condo or townhome, you're going to be limited to the homes that are approved. And lastly, with FHA financing, you have your upfront mortgage insurance. That usually will last either for the lifetime of the loan or for 11 years, depending on the underwriter, depending on the loan. So that's also something to consider because that will be an additional monthly fee on top of your mortgage payment and everything else that piles up on top of that. So again, if you can't get away from FHA and go conventional with no mortgage insurance or no upfront mortgage insurance, that'll be your best bet. So now that you found your realtor, now that you got your loan pre-approval, you're ready to go shopping. But first, let's discuss step number 4, and that's creating a must-have list of the things you want to have and the things you can compromise on. Ideally, your must-haves would probably be a number of bedrooms, maybe a square footage, and a specific location or school district, and stuff you can compromise on, such as a sparkling pool, maybe a 3-car garage, or solar panels. Having that list will definitely help you narrow your search down, and you won't get overwhelmed with all the properties that you're gonna see on the market. And something I mentioned to all my clients is that be reasonable, be realistic, and compromise. Stuff like colors on the wall, carpets, flooring, maybe even kitchen, bathrooms, it could all be changed. However, location, you can never change. You cannot pick up a house and move it to another location unless it's a mobile home, but we're not looking for mobile homes. Condos or single family homes, they're stuck. So ideally, you want to be in a great location or in a location that you're going to be happy with for the next 3, 5, 7, 10 years. And everything else inside the house you can change, such as color of the walls, carpets, maybe even kitchen down the line, outside color, landscaping, whatever, you could always change that. Unless you're in an HOA, then you're limited what you can do on the outside. However, on the inside, you're free to do most of the stuff. As I mentioned, it's essential to have that list and go by that list when you're looking for a new home. So once the list is ready, start looking at houses. Your realtor will send you homes. Attend open houses. Attend as many as you like in the neighborhood. Drive around, look at the neighborhoods. Open houses are free to enter. You don't need a real estate agent with you to get in. Take a look on your own time, see what you like. And if you like a house, call your realtor, maybe for a second showing or for advice. Something to keep in mind, don't go overboard. Don't look at 50 houses, 30 houses. Keep it on the lower end because you will get confused. You won't remember what the 5th house looked like by the time you reached your 20th house. It's just going to be a big blur. So if you're serious about buying, keep it down to maybe 3, 4, 5 houses at a time max. Per week, I would probably even say. And sit down, take a look at those houses and decide if any of those houses are a good fit for you or not. So let's discuss step number 5. You find a house that you like, it's time to make an offer. Now, where do you go from here? Well, a couple of things you or your real estate agent should do is first call the listing site and ask what's going on with the house. Are they having any offers? Are the offers they have currently higher than asking price or lower than asking price? Unfortunately, the selling side will never give you an exact number. They'll never say, well, we have offers for $505,000, submit more. They won't do that. However, they can say they have offers over asking, under asking, or no offers. Or also, it's a good idea to find out is, are the sellers looking for anything specific? Are they looking for a specific time to close? Do they need to stay at the house for longer or for a shorter period of time? So those things will definitely help to put an offer together. and submit a strong offer so it gets accepted from the seller, or at least it's more appealing. When it comes to making that offer, make sure to look at the contingencies. You have your inspection contingency, you have your loan contingency, and you have your appraisal contingency. Typically in Southern California, it's 17 days, which is standard. Ideally, if it's a multiple offer situation, you want to be aggressive on those and you want to cut those down as much as you can. That's something that your realtor will talk to the lender and see how low we can go. Some lenders will say they can do it in 7 days, some say in 12 days. So ideally you want to go as little as possible. And the same thing goes for inspections. If there's multiple offers, you don't want to take 15 days to go through your inspections that you could probably do in maybe 5 or 7 days. So ideally you want to cut those down as well. Now, another thing to consider is, are you going to ask for credit? If you're going to ask for a seller credit to pay towards closing costs or maybe a rate buy down, that's something you're going to do during your offer submission. Again, depending if it's a multiple offer situation, if it's a hot property and they have 5, 6, 7 offers, ideally you want to submit an offer that's as clean as possible. So there's no credits or very little credits, ideally no credits, and your contingency period is very aggressive, so very short. 5, 7 days for inspections, maybe, 8, 10 days for appraisal and loan, and possibly even a shorter close. Traditionally, it's 30 days. If you can close in 21, 25 days, that's a lot more appealing. So that's something to consider as well. And lastly is you have to put an initial down payment once your offer gets accepted. For Southern California or for California, it's typically 3% of the purchase price. So moving on, you put everything together. Great contingencies, great offer, it gets submitted to the seller. What happens next? Well, it gets reviewed, and typically the outcome is this. 3 things can happen. In the perfect world, it gets accepted right away, you open escrow and we move forward. Second step is it gets countered, or third step is it gets rejected completely and you didn't win the house with no explanation. Now, keep in mind that sellers, they're not obligated to counter, but most will do if they want to make a deal. So if you do get countered, you're going to get countered 2 different ways. One is going to be a counter straight from seller to buyer, which means that it's only you that's getting countered, which is great because then we can go back and forth and negotiate on specific terms that they countered that may not align with our interest or may not align with what we want to submit back. So we have time going back and forward. Sometimes, or a lot of times, if it's a hot property, you're going to see a counter that's a seller multiple counter offer, and that means that counter offer went to multiple buyers. So it could be all the buyers, could be just 2 buyers, we don't know. So typically what we see in a seller multiple counter offer is a common phrase, submit your best and final offer, on top of other stuff they may put as well. And that usually means submit your best and final offer, so the highest price you're willing to pay and the best terms, and that goes out. And at that point, that can either get rejected or accepted. So those are the 3 outcomes when submitting an offer. You made that offer, congratulations, the offer gets accepted. What happens next? Well, your due diligence period. So the diligence period is the inspection period, and this is where we review all the documents, such as the seller disclosures, just to make sure there's nothing wrong with the house or whatever they disclose, make sure you're happy with. Any HOA documents such as the CCNRs or anything else that comes in, title reports, make sure there's no liens on the property or anything that can affect our closing of the house. And of course your inspections. So I highly recommend doing inspections on the home. Typically you're going to do 3 different inspections if you're buying a single family home, and that is your physical home inspection, your sewer line inspection, and your termite inspection. Now on a condo or townhouse, you would typically do a home inspection, which is a physical home inspection, and possibly termites. Most of the time you won't. HOA or the homeowners association will probably take care of termites most of the time. So it's something that we could figure out depending on the complex, depending on what we offer. So if you're buying a single family home, ideally you want to do those 3 inspections. Now, something to keep in mind is that the home inspector, they're not a professional contractor, they're not professional tradesmen where they specialize in specifically plumbing or they specialize in roofing. That's not the case. They know what they're doing, they know city code, and they'll be able to go in and they'll be able to put on the report that, hey, the light switch doesn't work or there's a leak under the sink. So at that point, once the report comes in, typically what I like to do is go over everything, figure out what's important. Now, if it's major stuff like plumbing, electrical, roofing, we can get a professional to come out and give us an estimate or an accurate quote how much it will cost to fix that particular problem. Same thing goes with termites. Well, typically termite company will come out, they'll give you a quote already for the work, and same thing with the sewer. So With the home inspection, it takes a little longer, depending on what we find. During the due diligence period, it's essential to start looking for a homeowner's insurance policy. Now, that's a requirement for your lender. It's a way they protect their investment by lending you the money to purchase the house. And it also saves you from some risk as well while having that policy. So depending where you're located in the area, you may need fire insurance or flood insurance as well. So something to consider when buying a house. Now, in Southern California or in California, earthquake is optional. It's not required, but if you can get it, get it. It is more on the expensive side compared to other insurance policies. That's just a quick glimpse into the due diligence period. Now, every offer we submit, it's going to be different. Some may require the house to be sold as is. At that case, you're doing all the inspections, but you're not able to ask for any credit because it's sold as is. It's just more for your information, so you know what you're getting yourself into when buying that house. Now, it doesn't happen often, but there are some houses that are sold as is, and those are typically your fixer-upper homes that when you walk in, you could tell the house is going to need a lot of work, if not everything. So that's something to consider as well. Another thing to consider reviewing, and it's important, are the homeowners association documents. And this is assuming you're buying a condo or a townhouse or a house in a community. And the reason we like to review those is because you want to make sure that there's no pending litigation against your homeowners association. There's also reserves in the HOA, meaning that if there's anything major that happens with the complex and whatever HOA is responsible for, they're not going to come after the homeowners and reassess them for $10,000, $15,000. They're going to be able to pay it out of the reserves. So that's a crucial step. These are just some of the options that you have during your due diligence. Now, everything may vary depending on the house that you're buying and also on the buyer. If you do have any specific questions about due diligence period or any of the other steps that I mentioned previously, feel free to comment down below or schedule a meeting with me for a more of a one-on-one personalized approach, and I'll be more than happy to answer any questions that you may have. So let's move on to step number 7, and that's negotiating for repairs. So we reviewed everything. We got all the disclosures, we got all the reports from inspections, and it's time to negotiate for a credit repair. You sat down with your real estate agent and you came to a conclusion that you need $10,000 to cover the repairs. The real estate agent will put a repair request together and send that request to the seller. The seller has 3 options as to how they can proceed with that request. They can accept it and give you that credit. They can counter that credit with their own specific terms, or they can reject it. Now, in a perfect world, it gets accepted. Second best is it gets countered. So when it gets countered, you could still go back and forth and renegotiate as far as the number goes. A lot of times they will drop the number. It could be a combination of a possible seller credit, maybe a price reduction, or a seller will fix most of the items and give you a little less money towards closing costs. So it's all negotiable. Keep that in mind. You could always work out with the sellers, and I would say 99% of the times sellers are also flexible. They understand that the problem exists, and as long as you're reasonable in asking how much money you're asking for that specific problem, they'll be able to work with you. Simply because if they say no, you can cancel the deal and they put the house back in the market, chances are the same problem will come up with the next buyer and they're going to be in the same issue as far as getting credit. So essentially, they want to make it work, and most of the time they will make it work. Once there's a little back and forth with the seller and the buyer and the agents and everyone involved, we'll get the numbers squared away. And once the numbers are squared away and agreed upon, we're done with the inspection period and due diligence period. So what happens next is we remove the inspection contingency. So something to consider when removing your inspection contingency, you want to be 100% certain that you're happy with everything, meaning that any due diligence that you did on the house, on the neighborhood, school district, next door neighbors, whatever it is, you're happy with this. Because once the inspection contingency is removed, there's no going back and saying, hey, I want to cancel this deal because I'm not happy with the next door neighbor, or I'm not happy with the neighborhood. I drove by at night and something happened. I don't know, whatever it is. You won't have that chance of going back and using that inspection contingency for your benefit, meaning that you can still cancel, but you're going to run into the risk of losing your initial 3% deposit. So before removing it, consider this. Make sure you're 100% satisfied with everything, including the house. You're happy with the house, you're happy with any inspections, and you're okay with having to fix whatever issues that the seller may not have credit you for. Step number 8 is the appraisal step. We got the inspections out of the way, we got that contingency removed. What happens next? Well, during your inspection phase, most likely your lender will order the appraisal already, so it's gonna happen during the same time. But anyways, let's discuss the appraisal and what happens with the appraisal. So an appraisal is essential to your lender. They want to make sure that the house is worth what you're paying for. So there's 3 possible outcomes when it comes to the appraisal and its value. The appraiser will come out, they'll evaluate the whole house, they'll review the sales comparables within a specific parameter and within a certain time frame when all other houses were sold. And at that point, they'll come up with a value. Typically, if you're buying a house, let's say for $500,000, they're gonna appraise it for either $500,000. Sometimes it does get appraised higher, which is great. That means you have a little built-in equity. And there are times where an appraisal can appraise it below $500,000. So what happens at that point? Let's say the house gets appraised at $500,000. That's great. There's no issues. We'll move on. A house gets appraised higher, let's say $510,000. That's great too. There's no issues. We still move on. However, if the house gets appraised at $490,000, there's a $10,000 difference. Now, the bank will not lend you the $500,000. They're gonna only lend you up to $490,000 purchase price. Of course, minus your down payment. So that $10,000 needs to come out from somewhere. Typically, the first thing we do is we go back to the seller and we say, look, the house didn't appraise for $500, it's $490, this is what it's worth, please discount it this much. And a lot of times they'll do it. They'll just simply say, okay, we'll reduce it to $490, call it a day, move on. There's a chance they may say no. So at that point, you could either bring an additional $10,000 out of your pocket or cancel the deal, get your money back and get another house. Or we can negotiate and maybe go 50-50 or 70-30, whatever that comes in. So those are the 3 options that you have if an appraisal does come in lower. Now, it doesn't happen often, but it does happen sometimes. Another thing to consider when it comes to appraisals is make sure the house is in good condition, livable condition. You don't want to have any exposed plumbing. You don't want to have any exposed wiring or holes in the wall or the roof. Otherwise, the appraiser will note it and the lender will require those items to be fixed prior to closing escrow. Now, if that does happen and your contingencies are removed or your inspection contingencies are removed, we can still go back to the seller and tell them, look, an appraiser wants these corrected. And again, most of the time, 99% of the time, a seller is willing to do those repairs. Typically also, FHA financing and VA loans are a lot more stricter than your conventional financing. So if you're doing FHA or VA, chances are an appraiser will find something wrong with the house that needs to be corrected. So that's pretty much just a glimpse into the appraisal world and how it works. It's relatively quick. An appraisal will probably be done within the first 7 to 10 days of opening escrow. We get the report. Most of the time the reports come in clean, so there's nothing to worry about. If there is an issue, like I said, everything is still negotiable. We can still go back and forth with the sellers and try to get you the best possible deal if there's an issue with the appraisal or repairs. Moving on, let's go to step number 9, and that's the final walkthrough. So that's the step where everything is pretty much finished for the most part. We got all the contingencies removed, we have the appraisal removed, your loan is coming up, so we're gonna get the loan contingency removed. The final walkthrough is essential because you wanna make sure that the house is still in the same condition, if not better, than when you first saw it, let's say 25 days ago. Because the final walkthrough will happen 3, 4, 5 days before you close escrow. So another good idea is during a final walkthrough, if there were any seller repairs, get the home inspector back. Typically, it's not as expensive as the original home inspection fee. They'll probably charge you maybe a few $100s for an hour's worth of work, but they'll go ahead and they'll see if the seller in fact did repair those items that needed corrected. So it's a good thing to do as well. And of course, walk the house, make sure everything's in place, make sure there's nothing missing there, make sure there's no holes in the wall. All appliances, if they were included with the sale, they're still there. I've had a few cases where a refrigerator was included and during the final walkthrough, the refrigerator was gone because the seller forgot that they included the refrigerator. So things happen. Essentially, you want to correct those items before you close escrow, before you send all the money out. Now, step number 10, and that's the final step. That's when we close escrow, or that's when we move to close escrow. At that point, your lender will give you a clear to close. They'll give you your final approval. You're good to go. We remove all the contingencies, so there's no going back. Once we reach that point where all contingencies are removed and you decide that you want to cancel, you will lose your initial deposit. Sellers will not release it. We can possibly negotiate partial, but ideally you don't want to be in that situation. At that point, you want to make sure that the house is 100% to your liking, that you're going to love the house, you're going to live in that house for the next 5, 10, 15 years, and you're happy with it. So closing time, your lender will send out the loan documents to the escrow company. Your escrow company will typically package it together, send it out to a mobile notary, and the notary will come to your house and sign loan documents. You do have an option of traveling to an escrow office and signing it there, but for convenience, a lot of people choose to have a mobile notary drive out to your house or to your work, explain the loan documents, sign it, and get it back to escrow. Now, once the loan documents are back in escrow, they'll package everything. They will also send you a final statement to show how much money you need to bring in, and it's gonna have a breakdown. So your next step as a buyer to wire the rest of the funds into escrow, so whatever that number is. Now, once escrow receives your money, once escrow receives the money from the bank, they will go ahead and officially close escrow, distribute all the funds. So all the commission will go out, all the taxes, all the money will go out to everybody, including the seller, and escrow is closed. So congratulations, escrow is closed. The next step, once escrow closes, depending on the county you're in, it has to get recorded. So the grand deed and title get recorded in the county courthouse. And as I mentioned, it can happen same day or it can happen the following day. It really depends on the time we close. So if escrow closes on a Monday, you're gonna get your keys on a Tuesday as soon as we get confirmation of recording. And same thing, if it closes on a Tuesday, you're gonna get it the following day. Unless, of course, we can close escrow and the county allows same day recording. Then if you close escrow on a Monday, you're gonna get keys on a Monday as well. There you have it. It's 10 steps in buying your first home, or as I mentioned, maybe your second or third home. For the most part, I would say 85 to 90%, those are the steps you're gonna take to buy the house, but things change. It could be a little more, it could be a little less. Things sometimes go sideways, sometimes they don't. So if you're looking to buy, if you're looking to sell, or if you're looking to invest in homes in Southern California, give me a call. I'll be more than happy to help. I have over 20 years experience in residential markets in Southern California. So I know what it takes to help you buy your first home, sell your first home, or if you're looking for maybe an investment property and want to discuss that, I'm more than happy to help as well. My information is linked in the description below. Feel free to schedule a one-on-one Zoom call with me and we'll do a more of a personalized one-on-one approach and discuss your needs and wants and go from there.